What if I told you over half of all cryptocurrencies ever created are already dead? Not down, not struggling, dead. And yet people are still calling this the future of money.
Who calls himself an entrepreneur, but is really just going door to door selling solar panels. Yeah, if you couldn't already tell, I don't like crypto. And by the end of this video, I'm confident you'll at least question whether the entire cryptocurrency industry is as revolutionary as it claims to be. Let's start from the beginning. The idea of digital money isn't new. Back in 1983, David Chaum introduced something called eCash, an early attempt at anonymous digital payments. For the next couple of decades, similar ideas existed, but they never really broke into the mainstream. Then, in 2009, everything changed. That's when someone under the name Satoshi Nakamoto launched Bitcoin and mined the first block. Suddenly, people had a new vision, a decentralized, borderless currency. No banks, no government, no middlemen. It was supposed to be money for the people, free from control, transparent, and fair. A complete alternative to the traditional financial system. At least, that was the promise. Because if you fast forward to today, the reality looks very different. Let's talk about Bitcoin, the gold standard of crypto. It's been over 15 years since Bitcoin launched, and yet it still hasn't become a widely used everyday currency. Yes, technically, you can buy things with Bitcoin. Some companies accept it. You might pay freelancers with it. You might even buy luxury items. But in normal life, you're not buying groceries with Bitcoin. You're not paying rent. You're not grabbing coffee on your way to work. Out of hundreds of millions of businesses worldwide, only a tiny fraction actually accept Bitcoin directly. And even when they do, most of them use payment processors that instantly convert it into regular currency. So Bitcoin isn't really being used as money. It's being converted into money. And there are reasons for that. High price volatility, transaction fees, slow processing times, and the risk of fraud. So yes, Bitcoin can function as a currency, but practically speaking, it's not efficient for everyday use. The reality is, Bitcoin has evolved into something else entirely. It's not primarily a currency anymore, it's a speculative asset. Its price is driven by supply and demand, hype cycles, and investor sentiment, similar to gold, but without thousands of years of historical trust behind it. And that brings us to the next question. If it's not great as a currency, is it at least a good investment? Well, not exactly. Bitcoin is extremely volatile. Its price can swing dramatically in short periods of time, much more than traditional markets. That's why most professional investors, the ones managing serious money, only recommend a very small exposure to crypto, if any. Not because it can't go up, but because the risk is extremely high. And sure, we've all seen the stories, people turning small investments into huge gains. But what you don't hear as much about are the losses. Because for every success story, there are thousands of failed projects. Since 2021 alone, millions of cryptocurrencies have been created, and a huge percentage of them? They're dead, completely abandoned, no trading, no value. When a company fails in the stock market, there's at least some structure, assets, regulations, accountability. But when a crypto project fails, there's often nothing left, just a website, a logo, and silence. And sometimes it's worse than failure. It's intentional. This is where terms like rug pull come in, where developers hype a project, attract investors, and then disappear with the money. So, naturally, the industry tried to fix some of these problems. That's where stablecoins come in. Stablecoins are designed to hold a steady value, usually tied to something like the US dollar. In theory, they're supposed to bring stability to crypto. But even that hasn't always worked. In 2022, one of the most well-known projects, Terra USD and its partner token, Luna, collapsed. The system was designed to maintain stability through algorithms, but when confidence dropped and people started selling, the entire system unraveled. Billions of dollars were wiped out in a matter of days, and events like that shook trust across the entire industry. Then there's the issue of exchanges, the platforms where people actually buy and sell crypto. You'd expect those to be secure, right? Well, not always. Take FTX, for example. At one point, it was one of the biggest crypto exchanges in the world. Massive investments, celebrity endorsements, global recognition. And its CEO, Sam Bankman-Fried, was seen as one of the most trustworthy figures in crypto, until it all collapsed. It turned out that customer funds were being misused, transferred into a separate trading firm. When people tried to withdraw their money, the funds weren't there. And just like that, billions disappeared. Even industry experts called it one of the biggest failures of corporate oversight they had ever seen. And situations like this highlight a core issue. A large part of the crypto space operates with limited regulation and oversight, which means more freedom, but also more risk. And yet, with all of this, the crashes, the scams, the failures, crypto is still here, still growing, still attracting attention. Why? Because at its core, it taps into something powerful. The idea of getting rich early, the hope of finding the next big thing. But that also creates a cycle. Hype, investment, collapse, repeat. And often the people who benefit the most are the early insiders, while everyday investors take the biggest risks. Now, to be fair, the underlying technology, blockchain, does have potential. It could have real-world applications in the future. But as of right now, a lot of the crypto space behaves less like a financial revolution and more like a high-risk speculation environment. So, no, I don't hate innovation. I don't hate the idea behind crypto. But I am skeptical of what it has become, because right now, it's not the clear future of finance that many people expected. It's unpredictable, it's volatile, and for many people, it's expensive to learn the hard way.